Welcome to the Market Stalkers course on supply-demand trading. My name is Diana Angelo and I will be your instructor for the duration of the course. I have been a professional futures trader since 2013, although I have been trading since 2009. These days I'm a managing director of a software house called Blatek, which is the company behind the popular Blatek indicators. Blatek also has a small proprietary trading department, so I'm also the head trader. I'm also a risk guardian and an occasional shoulder to cry on for our traders when their psychology gets in the way of their goals. To help you on this difficult journey to learn how to trade well consistently, I'll start by teaching you how to read supply-demand levels properly. Supply-demand is the backbone of the Market Stalkers method and our primary way of determining good trade entry locations. It's not the only way, but it's definitely the backbone. Reading supply-demand areas correctly on a chart is important because these areas represent institutional order flow. What's that? Well, it's where the large institutions such as banks and hedge funds have their pending orders waiting to execute. These orders are incredibly large, causing certain moves in the market to happen once they are executed. And these levels are visible on the chart if you know where to look. I'm talking about historical levels, particularly those where the large moves originated from, which means that the banks did actually have their inventories at those levels at one point, which caused these large moves away to happen to begin with. As you move through the course, you will realize that we are not looking at just any supply-demand levels, but instead we'll be looking for very specific looking levels that have a number of conditions under some pretty strict rules that need to be satisfied in order for a level to be valid as your zone of interest. I'm going to start by pointing out the difference between your traditional support resistance idea and supply and demand. The very first difference is that supply and demand is a way to look at the institutional order flow without actually having their order book. Because let's face it, even if you're working for a bank, you can only see the order book of that one institution. So for example, if you're working for Morgan Stanley, it's not like Goldman Sachs is going to let you walk into their offices to take a little gander into their order book to see where their orders are, right? So there must be a different way to do this, and there is. So how? Well, in short, by looking at the moves from large time frames and very specific price action formations, it will soon become very obvious where the interest of the large institutions really is. So here is a weekly chart of Aussie dollar that perfectly illustrates the issues when you're trying to trade through support resistance. So in theory, this looks great. But let's drill a little bit deeper. So when it comes to practical execution, attempting to just trade from pure support resistance without looking at how price action formed at the level, as you will see, it's incredibly difficult getting any kind of trades that actually work out. So here at number one is where your support was first created. Then at number two, you see it sliced through it, and in theory it looks like it bounced from it, but you would have needed like a 300 pip stop loss to even trade this, so that's not very realistic right there. And then at number three, again, it gets somewhere near the key level, but again, you don't get a fill because it never touches it. And then at number four, the support breaks. And according to the traditional idea, support turns resistance. Does it? It kind of goes way past it. And then at number six, you don't get a fill again. So as you can see, it's not that great, really. But if you apply supply and demand to this chart, just by looking for certain conditions to be satisfied before you even decide to blindly place a trade based on a support area, then you'll find that it's not about one single price. It's not about just one single price key level, but that the support or resistance are really very specific looking zones that in a lot of the cases can be traded successfully at least once, maybe twice. So let's go through the same chart, but I'm going to start putting little demands on it. If I point to this little circle, this is a reaction from a lower time frame. So remember, I'm looking at a weekly chart. It's a pretty big level. And you would have been able to see this buying wick either on a daily chart or even a 4-hour chart. So this particular trade would have yielded 1,400 pips. It's not a mistype. It's not 140 pips. It's 1,400 pips over just over a month. And then, not to mention that there's another reaction here. So this would be your second test. But let's leave that for now and move on to that second example where it sliced through the support. Here it is. So when something slices through the support, slices through the candle, by supply and demand rules, that level does not exist. So in this case, this wouldn't actually be tradable when it first happens. However, the price goes back to test it, and then again, you'd have a rejection through a very clear bullish engulfing. Both of these trades would have given you over 600 pips profit. Now, just to make things perfectly clear, Marcus Talker's method, we don't trade from a weekly chart. We look at monthly and weekly areas for a directional intention, and then we mark these areas as potential zones where, for example, on this chart, you know that when the price reaches this area, you want to be a buyer, okay? Because you can recognize that there is a weekly demand there. Going forward, we will also make the distinction between weak zones and strong zones, again, through a very specific, systematic way of looking at levels. So now I'm going to take you through the process of finding supply-demand zones. You will always start on a large time frame. There's so much less noise on massive time frames, and I look at the monthly chart every single week. I also look at the daily chart every single day, regardless of whether I'm trading intraday or swing. And by starting your analysis from the very large time frame and then working downwards, I refer to this as the top-down approach. There is one thing that is very similar to support resistance, because we're also looking at a chart in a horizontal way. So you're not going to be looking at the chart vertically through trend lines, Fibonacci's, Gann fans, and all of that. But instead, you're literally looking at the horizontal chart, going back to see which levels have not been traded through. So you're looking for price action that is already on the chart. You're not making up levels, which again is the case with things like fib retracement and to some extent trend lines as well. We'll begin by looking for obvious swing highs and swing lows. But one very important thing is that with these swing highs and lows, you cannot cut through candles. So starting from the current price, wherever you are, you start looking to the left of the chart to see what happened historically. Now, traditional support resistance involves price that cuts through candles. And I never really like that, because if the price goes through a low or a high, if you apply some common sense, it means that the higher or a low is invalidated, so there's no level there. Now, if a price then goes and creates a brand new level in its place, then you will have some new information and a fresh level that is tradable, but not until the price goes back to that area. So it needs to move away and then come back. When you're looking for your obvious highs and lows, you also need to look out for consolidating patterns, just like you will see on this chart. So here's the euro-dollar monthly chart. Here's one consolidation. Here's a sort of a massive bearish engulfing. Here's another consolidation and another and another and another. But let me talk you through all of these obvious highs and lows. So like I said, we're going to start from the current price and work backwards. We begin to look to the left of the chart, and you're looking for obvious highs and lows that don't cut through candles. What you're trying to do with this process is to find originating points of all of these swings, okay? So going back, here is one high, and then if I keep going, there's a high that's obvious, but unfortunately this price traded through it, so therefore it's invalid. Then I reach this low, and then if you keep going backwards, this high is valid. Then there's another high, but again, not valid because this one traded through it. This is a valid low, this is a valid high, and so on and so on. Now you want to practice this. So let's start by opening up a chart. So go to your trading platform, whichever one you're using, and open something that's traded quite a bit, like Euro dollar, Aussie dollar, or something like that. And then start looking for these obvious highs and lows. Once you've located your obvious highs and obvious lows, what you want to do is extend these rectangles back to the right and see what happens. Now notice that some of these rectangles have actually overlapped with one another, and you will notice that some of these zones are originating zones. For example, this one is an originating area. And yet some others, like this one here, is actually just overlapping this originating zone, and its high is just kind of popping into the area of this zone and then reacting from it. This means that these originating areas are reactive, i.e. they are zones of interest to a vast majority of institutional market participants that are causing these moves away. To move the price on a large time frame like this, you need some very deep pockets. And that's how you know that these moves that resulted from these areas are made by central banks, hedge funds, etc. Now I'm gonna kind of remove these overlapping rectangles just to clean up the chart a little bit. So now that I've done that, what remains is the supply-demand zones. Supply zones are where your highs are, so they're kind of equal to resistance. They're areas where you will be looking to sell, to become a seller. Demand areas are equal to support, so that's where you would become a buyer. Some homework for you. So somewhere on this page, depending on where you're watching this, you'll find a download link to a zip file with some homework charts. These are naked charts with a particular task. And then you will also find another document in there entitled Answers that contain correct analysis so that you can see how well you did and whether you missed anything. And now let's move on to how to draw the zones correctly. I'm going to introduce a couple of new terms here to distinguish between the proximal area and distal area of the zone. Kind of like port and starboard on boats, so that there's no confusion of where the trade entry will be. So to draw the zones correctly, let's first use two lines. This is the two candle demand, pretty simple, created from a bullish engulfing. So this is the bullish engulfing I'm referencing. Now when you have a simple two candle zone, the open of the previous candle will be your conterminous line. Conterminous line is an area where you will be looking to enter your trade. As this is a demand, that means that you will be looking to enter a buy trade, aka a long trade. Conterminous as a word means to have something in common. And the reason why I chose this term is because these two candles at one point had a common price point. When the price stopped moving in the same direction, which happened when this candle started, at one point in time, these two candle bodies looked identical. So the second white candle then continued to turn around, crossing this common price point to eventually close higher. And that created the engulfing candle. But by going higher, the buyers took control and therefore created the conterminous line, aka the common price point. Conterminous line will become your first area of interest when the price pulls back to visit this demand. Conterminous line therefore represents an area where the price first faltered. It stopped moving in the same direction and then started to turn the other way. So in other words, conterminous line is a key level where the other side took control of the price. Now the absolute edge, the distal area of the zone, I'm going to name a borderline. The borderline will be used to place your stop loss, but not exactly on the borderline. Instead, you will be placing your stop loss a few pips below it. Borderline is the edge of the zone. In this case, it's a demand, so it will be where your low is located. So let's have a look at some supplies. Here is a supply that has several candles. It's slightly different than the 2-candle example. So think about how the conterminous line is created. It's the first area where the price faltered. So if you have a number of candles that come after that first candle failure, where will be your conterminous line? It's going to be at the first black candle in this case, which is this candle here. And then you have another 3 candles of arranged sideways movement before the actual move away happens. So the conterminous line in this case, when you have several candles, will be the close of the first candle that faltered. Now this is an example of a supply. Therefore, you will be looking to sell. So it's in that way, it's similar to resistance. Your borderline is going to go at the obvious high. So the stop loss will be based on your borderline, few pips above, because it's a supply you're looking to sell. Here's another example of a multi-candle area, but this time it's a demand. So here's your obvious low that you located, and this white candle is the first candle that stopped moving in the same direction. Therefore, this first white candle is going to become your conterminous line, where you want your pullback entry to happen. Now I want to show you some other examples just to make everything really clear. Here I have an example of 2 demands that are moving in an uptrend, right? You're not supposed to trade the middles. So with supply and demand, ultimately you'll be looking to trade the swing extremes. But recently with the Udemy course, we've had a number of people asking what happens when you have a demand in the middle of a swing. Where does the conterminous line go? Where does the border line go? So here's an example of 2 demands moving in an uptrend. So in this case, you have 2 bullish engulfings, and the rules are exactly the same. So you will have the open of the previous candle that becomes your conterminous line, and your borderline goes below the obvious low. If you're looking at this area as your obvious low, clearly your borderline is here. Your conterminous line will be at the open of the previous candle. So it's all the same thing, but generally you want to avoid trading middles. So really, if you're looking at a chart, you're only going to be interested in this particular demand here. Now let's go back to this euro-dollar chart for a minute. If you remember, some of these zones were the ones where the initial moves originated from. But then you have these overlaps that represent reactions from those originating zones. So here was one of them, and here was another one. Now, the zones where the move originated from, I refer to those zones as parental zones, as in parents, mom and dad. The overlapping areas that are reactive, I like to refer to them as offspring zones, as in children. Now, offspring zones can sometimes have another third reaction from them, but in a lot of the cases, the price will go all the way back to the parental zone. In that case, offspring zones, such as the one you see here, have a slightly lower probability of working out or getting you that bounce that you're looking for. And this is also because technically by the time the price tests the offspring zone, it's already that second test of the area, which means that there may not be enough orders to provide enough volume and momentum for another bounce. Of course, I'm talking about institutional orders, not retail orders. So all supply demand zones are ideally valid for trading the first pullback into the zone and then any subsequent pullbacks into the area generally weakens the zone. Here are several other things that you should keep in mind when drawing the zones. The first one is that the move away from the high or low, or the consolidation that you've seen, it should ideally be a big move. The bigger the move, the stronger the zone. Number two is that the prices should stay away from the zone for extended period of time. If they come back to it after that one big move and then there's no follow through, there's no second candle that goes in the same direction, this signals that the zone is not that strong. So ideally, you're looking for at least 2 candles move away from that faltering area / consolidation. And finally, you need to look at the profit margin of the zone. Profit margin means how far did the price move away from the initial zone. I'm going to cover each of these points in the coming lessons. So this was lesson number 1. Let's recap what we've learned today. So I showed you the difference between the traditional support resistance and supply and demand. Then we were looking at how to locate the zones, first by looking at highs and lows that don't cut through candles, aka when price hasn't traded through them. Then we looked at drawing supply-demand zones correctly along with conterminous lines versus the border lines. And finally, I was mentioning parental and offspring zones. So offspring zones can also be called the pivotal area, pivotal zones, because they pivot from the previously existing supply-demand area. For your final homework, I would like you to get any chart from anything that's already widely traded, something like Eurodollar, Aussie dollar, GBP yen, so any widely traded instrument that has plenty of liquidity. And I then want you to keep going through this process of finding untraded highs and lows, drawing the conterminous and border lines, and then marking which zones are parental, aka originating zones, and which ones are offspring zones, aka pivotal zones. And this concludes lesson number 1 on supply demand.